Welcome back, my awesome people. I am here with another interview with Austin Graff of Opal Capital, and he will be letting us know of what is going on with his company, how their fund is a lot different from others, gain the maximum amount of gains that you can, but also letting you diversify your portfolio. So, welcome, Austin. How are you doing today?
Hi, Jacob. Thanks. I'm doing well.
Awesome. So, Austin, just to start off, can you provide us an overview of Opal Capital, its history, its core mission?
Yeah, so Opal Capital is it's a registered investment advisor in the U.S. It's essentially the result of about 20 years of industry experience on my part, and then we've slowly built out a broader team. And so we launched as a U.S. dividend focused investment management firm. And since then, we've added on additional competencies. We also have an outsourced CIO business to not only be able to most effectively invest client money, but also effectively grow their businesses. So we're trying to be a one-stop shop for advisors and for retail investors.
And you know what? That's the beauty of having dividend funds or ETFs and so on. Because me personally, and a lot of my viewers, we are very dividend heavy investors. So, what are some of the primary investment strategies that Opal employs? I know you mentioned dividend, but is there any other strategies?
Opal Dividend Income Strategy, which is a U.S. focused dividend strategy that we offer in both a separately managed account and ETF format. We have an international dividend strategy, which we offer as a separate account, and we're currently launching an ETF in that. And then from the outsourced chief investment officer perspective, we offer a suite of portfolios that are customized to client need, primarily focusing on ETFs and SMAs that help clients achieve their desired objectives.
Okay, that's perfect because when I invest in dividend heavy or dividend playing stocks, I always not only look at for the expense ratio, but I also look at the yield. So currently, what would you say the average yield of most of your ETFs and funds look like?
So currently, the yield is anywhere in the 3 to 4% range. Dividend funds tend to come in one of two flavors. They tend to either be a low yielding fund with significant growth over time, or a high yielding fund. And so, from a low yielding fund with growth over time, the problem with that is it doesn't provide much of a dividend today. But they do like to market a yield on cost after like 10 years at being something that looks more normal. The problem with that is most people don't stick with these things for 10 years. And a lot of people, especially baby boomers in the US today, need money today. On the other end of the spectrum, you have high yield dividend funds. Unfortunately, these tend to be your typical value traps. Often the yield got extremely high for a reason, and they tend to be dropping those dividends over time. So you miss the benefit of kind of a growing income stream. So what we've put together with our products is an attractive dividend today that's also growing over time. We think it's a great way for consumers to kind of offset inflation, as our dividends tend to grow at anywhere between 5 and 10% a year. One of the unique aspects of our ETF is we pay monthly. Um, so you actually get a distribution on the month every month, which we think is advantageous for investors.
Yes, I definitely agree with the value traps because I have invested in a few stocks that had high yielding dividends, such as AT&T, for example, and currently it's not doing too well. It's still they had to slash their dividend about a year ago due to the price dropping. So, what would you say differentiates Opal Capital from other management firms? I know there are tons and plenty of management firms out there. They all have their own, expense ratios. They all have little perks and little things that they differentiate from one another. But what does Opal do that differentiates from the others?
Yeah, so first you get a deep bench of industry expertise. So myself and co-portfolio manager Adam Mueller have 20 years of experience investing in dividend-paying equities, which we think benefits clients. But more importantly is how we leverage that experience to provide a good outcome for clients. So first off, we have a lot of skin in the game. Second, we tend to take a relatively focused approach. So our strategies are in the framework of anywhere between 20 and 35 names. So it's going to be much more concentrated than your legacy active managers, which look more like index products. And then finally, we utilize a forward-looking approach. So we tend to try to identify companies that are going to grow dividends over time by looking at the company from a forward-looking fundamental perspective, making sure they have significant free cash flow and the resiliency in the business to maintain and grow that free cash flow, because we know that contributes to dividend growth over time. So we think when you put the combination of those factors together with our backgrounds, we have a pretty unique offering in the market.
Okay, that's actually good to hear from my viewers, because I always get questions from my viewers saying, Jacob, how do you differentiate between what company to invest in and what company not to invest in? And I always tell them, look at the people managing the actual asset, the people in the background, because you can have the best yield, you can have the best growth in a year, but that can always come down. Just like I'm sure you've noticed during COVID, a lot of companies ran up 200-300%. And then as soon as the lockdowns were over, guess what happened? They all tanked because obviously, their portfolio, their numbers weren't as accurate as it should have been. So it's actually good to hear that you guys are growing with the companies that you have invested in. And so what would you say are some of the key sectors that most of your ETFs deal with? Like I know some asset managements focus more on just the finances, some focus on healthcare, or are you guys just like kind of a mixture of many sectors?
So we focus on a mixture of many sectors, and we tend to own more stocks and what we believe to be secular growers, where we can find attractive dividend opportunities in those growth spaces. So right now, for example, we own a relatively high concentration in chip manufacturers and chip companies, semiconductor companies, because we think they're going to benefit from AI. One of the problems with that secular trend, though, is it's been relatively played out in the market. So we've looked for other areas that can benefit from AI, one of them being utilities, whether they be regulated or unregulated utilities. It's a great way to get dividend yield while also getting some, I would say, changing growth. So if you look backwards, utilities have kind of grown at like a GDP to GDP minus level as we've seen the economy become more efficient in use of electricity. But going forward, electricity demand is increasing per unit of GDP, which we think is bullish for utilities. Many people look at valuations by just looking at the last 10 years and saying the last 10 years is going to be what we're going to see over the next 10. But given that we've seen the change in growth dynamic, we think the valuation should change as well. So we think utilities are an interesting place to be. As we've looked at kind of a flattening yield curve, a lot of traditional traditional dividend sectors haven't performed as well. So like consumer staples, like healthcare, even utilities to an extent haven't performed as well as more cyclical names. We think that trend could last for some time until we see a more steepening of the yield curve. So we're likely not going to rotate significantly back into some of those more stable names until we see that yield curve steepening a bit. From one last area that we focused a lot on and generate a lot of outperformance from is actually the energy space. There's a lot of good dividend payers in the energy space, mainly oil drillers and refiners, and they've significantly outperformed, not because of some crazy like governmental policy. It really just comes back to the fact that demand for oil continues to increase even though electrification is taking some share. As we've seen supply come down a little bit, it's been tremendously bullish for some of the oil and gas companies. So that's been an area that we've generated a lot of performance as well.
And yes, I was just about to mention that with the utilities, energy definitely is the number one sector, I would say, for not only reliability, but also a good dividend output. But just to talk about the electric, with the increase of EV cars and almost everything going electric, do you think that the electric grid will be able to handle all of the electricity needs that we need as consumers? Like, as you said, right? There's talks of oil kind of coming down a little bit, but we still need oil no matter what. Oil and gas will always be our blood in this system. But what do you think about the EV sector, the electric sector?
Yeah, so in the US, EVs are not a significant chunk of actual the auto fleet. I think it's something like 5 to 8%. So it's not a huge deal right now. It could become a larger deal over time, but EVs haven't sold as well as people expected. I think a bigger drive for electricity demand right now is artificial intelligence. We're seeing that creating a pretty significant draw on the grid. There's kind of a push and pull here though, right? Like people talk about how like artificial intelligence and data centers are going to go from low single digits to almost 20% of electricity demand over the next 3 to 5 years. That sounds like it sounds like people are running around with their hair on fire, right? Like it almost sounds like it's an apocalypse situation, because if you could imagine, you can't really store energy very well. And so if you see demand increasing by that much, it takes a long time to put more assets into operation. So you'll likely see like brownouts and blackouts across the country. The thing we have working for us, though, is the fact that AI is tremendously energy intensive today, or electricity intensive today, but they're using AI to reduce that intensity over time. And so you get the kind of the demand pull of the fact that there's going to be a lot more data that needs to be crunched and a lot more electricity that's flowing into these data centers. I do think demand is going to be growing at a greater than GDP rate going forward. I would caution people from looking out and saying, hey, it's going to be growing at like 3 or 4 times GDP, right? So maybe utilities are going to go from like a historical, low to mid-teen multiple to a future mid to high teen multiple, with growth that used to be in the 1 to 3% range to growth that's going to be in the 7 to 9% range.
So it's not going to be that, it's not going to be in a current panic mode at this moment. So maybe in the next 20 to 30, 40, 50 years, maybe. But at this moment, everything when it comes to electricity and when it comes to the demand is not as great as people are, I guess, panicking about and putting it out there. And I do agree that AI is going to be used for a lot of good stuff in the future, especially reducing our energy consumption, our carbon footprint, and so on. So how do you think that's going to change the landscape of investing?
Yeah, I think it's really interesting. And honestly, I have no clue. And I think anyone that's sitting here telling you that they know how this thing's going to shake out, they're fooling themselves and trying to fool you. Like the people who are putting tons of money, tens of billions of dollars into AI are the companies that have tens of billions of dollars to invest. It's not clear that they are going to be winners. So who is actually going to generate the incremental revenue from the tens of billions of dollars invested in AI? Is it going to be Meta? Is it going to be Amazon? Is it going to be Google? I don't think anyone really knows at this stage. And from that perspective, we are kind of in like a mid to late 90s framework where there's a ton of money chasing these far off opportunities, and no one's really been able to quantify who the winner or loser is going to be. I think when you look out, like if you looked in 2020 or 2015 and you looked at who the winners and losers were in 2000, you're like, man, I should have invested in Amazon, right?
Yeah.
You couldn't have even invested in Google at the time because it wasn't public. Right. But people tend to have that like revisionist bias. Like I would have done it had I they think that they would have done it in that time if,
they surely wouldn't
had they
have
only known. Right. And so I think right now it's really hard to sit here and be like, I absolutely know one of these guys is going to win. So if you really want to play the AI and the future of AI trend, I would recommend taking more of like a venture capital approach to that, rather than taking what we consider to be more of a private equity approach. So with venture capital, people take a bunch of bets and they spread them out far and wide, right? And if they have 1 or 2 winners, they're tremendously successful. But with private equity, you do a lot of really deep research and you own a handful of names, and you expect each of those names to be relatively big winners. To give you great returns over time. You might have 1 dud, but if you have 10 names and you have 1 that doesn't work, you've still done really well. I think if you're going to look at AI as this like long-term trend, take the venture capital approach and sprinkle your money around to a bunch of different ideas and opportunities, because we don't know who's going to take the lion's share of the market. If you're going to focus on some of the suppliers, people who are providing capital into the AI data centers today, then it's okay to take more of the private equity approach. So let's find a couple of names that have great products, that they're monetizing it today, I would say NVIDIA is one of those names that's been able to monetize a product today. But also look at some of the utilities, because you could look at utilities in Virginia, right? We know there's a huge data center concentration in Virginia. So there's likely to be significant demand in electricity that's got a very long tail to it. That's something that we can invest with. But I think you got to kind of bifurcate how you think about investing, if you're investing for moonshots or you're investing for nice solid like cash flow generators today.
No, and you know what? I actually see that as well, because when it does come to AI or any form of technology, you can have 10 very different technological companies, and at the end of the day, maybe one or two will be the winners. Because I still remember when Y2K happened, there was at least 10 to 15 companies that were vying for the we will be the first, we will be the first. And I mean, at that time, Amazon was still selling books. Nobody ever thought that they were going to go into, being the number one shipping and
Right.
Technology company. And also just currently Nvidia. I mean, we all knew Nvidia was going to be something. However, we didn't know how much of a something it was going to be, because right now Nvidia is pretty much carrying the tech sector. And as you mentioned, right, Google was not even in the picture during that time. And look where they are now. So you're absolutely right. It's better to go with the venture capitalist theory if you're going to kind of play the game, or if you're going to look for that steady income, go for the private equity. And that's, I'm guessing, exactly what your fund does, right? It monitors your team is very hands-on, and they track and also buy and sell according to the needs of not only the customer, but also the economy. So what would you say, for example, since we're talking about your team, what are some of the qualities that you believe are essential for your leaders within your organization to not only return as much for the client as they can, but how do you create this awesome Avengers team?
Yeah, I think I think a team is really important, right? So we don't want anyone who thinks that they've got all the answers, right? Like, you don't want someone who thinks that they can do this without a team, because it doesn't work, especially in this day and age where you have information coming at you so quickly. For one person to work through all that information, decipher it, and come up with all the right decisions. So a team is important, even if it's a small team. I think another really important aspect to the team is humility. We understand that we don't have all the information, and so we're going to get as much information as we can to make an educated decision, and we're going to move forward, and we're going to be willing to admit when we made a mistake and move on. I think one of the Achilles heels of many investment teams, and we've seen it over the last decade or so, is they like to sit here and they like to tell people that they're right and the market's wrong. Right? The market doesn't care what you think. It's going to keep doing what it's doing. Your job is to operate within the market and understand that. Right? So I hear a lot of people, especially when we talk to advisors, who are like, I can't believe what the market's doing. These people are insane. They don't get it. And in reality, that's not your job. Isn't to tell everyone else why they're insane. Your job is to figure out what's working and participate in what's working while not participating in what's not working. So we think that humility is a really important part of investing. And then curiosity is also very important. So I think one of the more important things is to look back historically, understand what's happened, understand why it's happened, and then be able to layer that into what's going on today and how we can take advantage of the current environment to provide the best outcome for our clients. So when it comes down to, we like teamwork, we like humility, and we like curiosity. Notice I didn't say anything about IQ score. I didn't say anything about what school you went to. I think that some of that stuff is less important, and really it comes down to being curious and humble as you kind of evaluate the market.
You know what? That is the perfect way of saying it. And not only does that apply to finance and investments, but it also applies to any business, right? You would much rather have a team where everyone is willing to listen to each other, respect each other, work together, rather than have those two or three people saying, I know it all, I know it all. And then to your point about many financial investment advisors and so on, always thinking that they know better than the market. Many of my viewers have always asked where, hey, Jacob, I got duped, last year because I listened to this one advisor who said that market was going to crash. And so I sold before it was supposedly going to crash, but yet the S&P just went, straight to the moon. Don't listen to everybody that just speaks and wears a tie. Okay. So always look deeper than that.
We have a thing that says avoid gurus, right? If there's someone on TV telling you what to do over and over again, they're likely not as good at it as they're indicating they are, because they wouldn't be on TV telling you about it if they were so great at it, right? They'd be keeping their ideas to themselves, would be minting money, living on a beach somewhere, rather than, schlepping to, New York City to get on TV and tell you why you have to own Caterpillar or something like that, right? Like
just like Kramer.
Guys, yeah, they're talking their book, and they're trying to get you to buy things that they already own. And they have a vested interest in convincing you to do that. So just take what they say with a grain of salt, and make sure you have your own evidence to back up what they're saying, because I wouldn't bank on them having evidence backing up what they say, right?
Oh yeah.
So you have to do your own work, right? Unless you're hiring someone else to do it, no one's going to just hand you great ideas for free. It's just not the way the world works.
Always have to do your own due diligence, right? As soon as your neighbors and your family members start talking about a stock or start talking about an investment, it's already too late. That's so funny, because I still remember Mad Money with Kramer. They had the inverse Kramer stock, where whatever he said, you do the opposite. And actually, I think based on the statistics, there was, I think, a 17% return if you actually did the inverse Kramer. So it's actually funny that you mentioned that. So what are some of the top priorities for Opal Capital for the next 3 to 5 years? Are you, I know tech and AI and energy and utilities is the main focus currently, but say in the next 3 to 5 years, are you guys going to continue focusing on these sectors, or is there something coming up that maybe has not been announced yet, or what do you think is going to happen with your company?
Well, so from a corporate level, we're launching an international fund. Adam and myself have a deep history in managing global equities. We used to both be portfolio managers in the global dividend equity suite at PIMCO.
Nice.
So we're launching a global fund, which is going to be more focused because of the international composition of markets. They'll have a higher yield. It's going to be more focused to more traditional industries, which tend to be the better performers in those parts of the world. The tech dominance is very much a U.S. phenomenon, likely because of some of the ways that IP is treated, and some of the regulatory regime that's more favorable in the U.S. than other parts of the world. From an actual investment horizon perspective, it's really hard for me to say, like, in 6 months, this is where we're going to be looking, mainly because of the answer on, like, we want to be humble, we want to be kind of seeing what's going on in the market. But one of the things that we're keeping a very close eye on right now is the steepness of the yield curve. And not just the steepness of the yield curve in the US, but the steepness of the yield curve globally, because we think that's a good indication of if we're going to see some real economic growth in the future, or if we're going to continue to be in this kind of muddle through phenomenon. If we're in muddle through, where people are really questioning the future of growth, it's kind of counterintuitive, but that's when you need to be invested in more growthy oriented sectors and equities. That's when growth is more abundant throughout the economy. And that's when we expect value sectors to outperform. So that's when we would expect some of these more cyclical in nature, like whether it be steel companies, whether it be equipment manufacturers, that's when we think that they'll carry a lot of the water. Right now, the yield curve is relatively inverted, really flat. Depending on what you think's going on with the election cycle, it may peak up a little bit, maybe not. And so we're seeing a lot of sentiment sway around the yield curve, but we're not necessarily seeing the yield curve change. And so we're not adjusting portfolios just because people are getting super excited about, the next presidential candidate that might win, or super upset about, their favorite presidential candidate may not win. We're focusing more on what are the underlying facts that will drive a change in the market. And once we see those facts play through, then we're likely to take action.
Yeah, and so that's actually a perfect thing that you said, because my next question was going to be based on the upcoming elections. How will, I know depending on who the winner is, the United States economy will differ. However, what would be, I would say, perfect case scenario for your company when it comes to the policies, regulations, red tape, opportunities? Because I know I've spoken with other CEOs and financial companies, and of course, they are all going for more of the Republican side because it will loosen the red tape, it will loosen the regulations. And I'm guessing maybe your company's in the same position, or it might differ. What do you think?
Yeah, we don't try to position ourselves to benefit or be harmed, whether one side is in power or not in power. We look at the rules that are in place today and the likely rules that will come into place, and then we try to compete based on what's in what's the rule of law. I think you got to and I don't honestly I don't provide any kind of political views because I feel like if you let your politics seep into your investments, then you're actually doing yourself more harm than good. Right, especially right now in the U.S., if you pick one side or the other, you're actually upsetting half of society essentially because there's so much of a like polar opposites out there. I don't think it's a winner's game to sit here and bet against half of society. But from a perspective of, I think people also should think about like what's happened in the oil and gas space, right? So if you look, when Trump, who was supposed to be a huge proponent of oil and gas, when he was in power, oil and gas companies did horrendously, right? And some people say, oh, that's because you have 2020 embedded in there. No, the issue is it's a supply and demand market. If you oversaturate the market with supply, your demand is relatively stable. So you see prices plummet. And that's what happened under Trump. As soon as Biden came in, even though Biden has a lot of negative rhetoric towards the oil and gas space, the first thing he did was cut back in permitting for oil and gas on federal land, right? So all of a sudden they started soaking up all this supply. And by the way, demand stays really stable. And so you've seen prices shoot up under Biden because he's trying to restrict the amount of new oil and gas that flows into the system, which has been a tremendous tailwind for oil and gas companies. Most people don't actually understand how that is working, and they think that, oh, if Trump's elected, that's going to be great for these companies' bottom lines. It might not be, because there might be a tremendous amount of supply coming online, which is bad for future free cash flows. You see the initial knee-jerk reaction is like, oh, Trump and JD Vance now are going to be in office, so let's bid up oil and gas companies. I don't think that that's actually the right move. I think that the market might rethink that over time as they look at the actual facts and focus a bit less on the emotional response.
You know what? That's actually a really good point that you mentioned, because I did not even see it that way. I always thought, based on what we're told, is when Trump was in power, oil and gas was the hurrah, and when Biden got into power, it got reduced. But you know what? You actually make a very solid point where even though he was in power, gas didn't do too well because he oversaturated the market. And then when the next in power came in, started cutting back, that made the demand soar, which ultimately increase the share prices of many utilities companies. We have to talk about cryptocurrency. What do you think about cryptocurrency, and what does your company think of it as well? Is this something maybe you might make a fund for it in the future? Because I know, you have the big players like BlackRock and all of them just touting it. What is your not only personal opinion, but what is your professional opinion as well?
Yeah, it's hard. I don't know enough about crypto to have a strong view. I'm not going to sit here and tell you that it's the greatest thing in the world or not the greatest thing in the world. I tend to think that there's not enough of a track record from a data perspective for us to make really good decisions off of it. And I don't understand how supply and demand in the crypto space works well enough for me to put something together that I think make sense for clients. Now, I've heard a bunch of arguments for why you should or shouldn't own crypto. And I can say that there's just not enough data for me to get behind one argument or the other. And I like to take more of a scientific approach where I have, a decent amount of history with facts so that we can make decisions that make sense rather than just making emotional decisions. And so while I understand that there are a lot of people on TV who are pushing individual investors to make emotional decisions around crypto, it's not something that we're going to participate in anytime soon. I'm surprised to see how quickly, well, I should say that, I should restate that. I'm surprised at how quickly the large institutions switch from being completely anti-crypto to being supportive of crypto. And I think the only thing that diminishes that surprise a little bit is how quickly it's grown and turned into a cash cow for those companies. One thing that I do know about many of these large financial institutions is they are extreme opportunists, right? If there's a place to make a buck, you should expect to find them there. And it shouldn't surprise anyone that they thought, crypto was like, something that looks more like the devil a couple of years ago. And now they're its biggest proponents, right? So I think it's a place, be careful if you are going to participate, and try to get as many facts as possible so that you can make those scientific decisions that are based in facts rather than what we feel are a bit more emotional decisions, which can turn into being mistakes over time.
Yeah, no, because I remember a few years ago, you had all the big banks, Chase, JP Morgan, all of them were anti-crypto. They were like, nope, we are not entering. We are not going to go with this asset that literally has no backing, and it's just about a community's trust. And now, as you can see, it's everywhere. Everybody's applying for this fund and applying for that fund. And I think eventually it will be something that might become big, but at the same time, I think we just recently saw about a month or two ago how crypto almost got cut into by 50% over, just regular news. It wasn't like it was big major news. It was just people's sentiment, right? FOMO, fear of missing out, or, oh no, it's dropping, I have to sell. So as you said, right, it's a very emotional based asset. How many funds do you currently have, your company?
We currently have one fund. It's
The one major
DIVZ
fund,
is the
right?
ticker. Yeah, it's an ETF, completely transparent, actively managed, 25 to 35 names. It's talks the whole like U.S. dividend construct where we're looking for attractive dividend today and growing dividend over time. We charge 65 basis points for that, which we feel is attractive for a truly active fund. There are a number of passive funds out there that charge less, but we think that you run the risk of falling into traps with those funds and not necessarily getting the best outcome for shareholders. And so that's where we think positioning for the fund is relatively attractive. We're launching an international fund, should be out in the next, call it 3 to 6 months. It's going to be a very similar flavor, just different geography. And those are our main kind of SEC regulated funds. We have separately managed accounts that we manage as well. Those are done through Schwab and Fidelity. And so those are the main products that we offer.
Perfect. So you have one fund that focuses on the US dividends, and then you have another fund coming up that focuses more on the international aspect. And when it comes to the international fund, would you say there are going to be North American assets, or is it going to be 100% outside of North America?
We will have some Canadian stocks in there for sure. But it's likely going to, I mean, we own some North American assets in the U.S. fund. So we own like TSMC, which has an ADR that we own. We own a company in CRH that was listed in London. It switched its listing to the U.S., but we owned it prior to it coming to the U.S. We also own British American Tobacco, which is an ADR as well. So we do own some non-U.S. companies in the U.S. fund. I don't expect to own too many U.S. companies in the international fund because we're trying to provide that non-U.S. exposure in that product.
Perfect. Okay, so Austin, that was plenty of information, not only in your US dividend fund, but also your upcoming international fund. And thank you for those awesome, insights, because I learned quite a bit today, and I'm sure my viewers will be learning quite a bit once they watch this video. So just to end off, any last points, anything that you want to mention, not only to my viewers, but just to put it out there?
I just think that everyone should focus on the facts and make sure you keep supply and demand in mind when you're investing, because I think far too often, the market sentiment or dialogue tries to push you into making emotional decisions. And if you focus on facts and supply and demand, it can keep you on track rather than letting you fall off course, as many of those other kind of mediums will push you towards.
Exactly. So make sure, my viewers, you do your own due diligence. Please do not just watch the people on television who are screaming at you and telling you to buy this and buy that. And so, my viewers, if you have any questions, I will be putting Opal Capital and Austin Graff's details in the description box. So you can definitely check out the US dividend fund. I'll be putting the ticker symbol at the bottom as well. And once the international fund is incepted, I will also be updating this video with the international fund at the bottom as well. So Austin, thank you so much for this interview. And my viewers, please check this video out. And if you have any questions, put it in the comment below. And remember, like and subscribe. So until the next time, stay ranting.